apologize. As soon as she walked in, I fucked up the title of her book. The title is All the Devils Are Here, The Hidden History of the Financial Crisis. And she's my first guest. Please welcome Bethany McLean. I know you're not supposed to ask this, but you're pregnant. Right? Yeah.
I hope it's obvious at this stage.
Well, congratulations.
Thank you.
Yeah. So the book, I enjoyed the book immensely.
Thank you.
But I have to say, it's completely out of my wheelhouse. So when we talk, pretend that I'm a third grader who's had a few drinks. Okay. So the story begins 30 years ago, basically, and that is really the beginning of all these complex financial products. We're beyond just the 30-year fixed. We're beyond just stocks in a company. And it gets into all these things a lot of us have heard of, like credit default swaps, derivatives, CDOs, stuff that we know. We've heard the names, but we don't quite know what the name is, what they mean, rather. And I guess my question is, were the last 30 years really a significant change in the way Wall Street did business, or is Wall Street always innovating and this was just the latest stage?
I think it was a significant change in the way Wall Street did business. And by the way, if I don't explain something in clear terms, that's my fault, not anybody else's fault for not understanding it. Because if somebody says something in a way that's too complex for you to understand, it's usually because they don't understand it well themselves. So I'll apologize in advance.
Unless the reader is a financial moron.
No,
like myself.
even then, I promise. But it really is a fundamental change on Wall Street. And part of it has to do with Wall Street firms once being private partnerships, where the people who ran them were on the hook for everything that went well and everything that went wrong. But once they went public and had shareholders and the public's capital to play with, it became this game of if we win, we keep all the winnings, and if we lose, well, it's somebody else's problem and somebody else's loss. And that, to me, was a fundamental change in the culture of Wall Street. And you had at this very same time this growth in what Wall Street likes to refer to as technology or financial innovation, which is really complex products carved out of other things. And so these two changes kind of went hand in glove. And if you look at the growth of the financial sector as a part of GDP, it's really frightening. I mean, the financial sector has come to really dominate our economy in a way that it never did historically. So I guess I'd put those three things in the category saying, yeah, things are really different than they were.
At the same time, you mentioned that when the initial people who started, and what we're talking about, the overview is these things called securities, bundling different financial products or mortgages, for example, into one group, diversifying risk.
Supposedly.
Right, okay. I guess my question is, when they initially came out, Wall Street didn't think, or did they, that they were screwing over the public. They thought they were actually making Wall Street safer.
Well, they thought they were doing a good thing, but they also thought they were making money. But those two things at the beginning seemed to go hand in glove. So the whole innovation of these things called mortgage-backed securities was actually a way to get more capital to American home buyers, so that a person who was buying a home in, say, Kansas could actually have that being financed by, say, a saver in China. And without turning mortgages into securities, that wouldn't have been possible. It was only local people in Kansas whose deposits would have financed the home in Kansas. And that made it a limited market. So the whole idea was we're going to expand the possibilities of home ownership for people. And we're going to, by the way, make a lot of money doing it at the same time. But the story of most stories of business gone wrong don't start with a bunch of people sitting in a back room saying, how are we going to screw up the system and how are we going to make ourselves rich in the process? They actually usually start with somebody having a great creative idea, and then it slowly starts to go wrong and it becomes corrupted over time. But so when you look for these defining moments, when I like to write stories of business gone wrong, when you look for these defining moments of the people sitting in the dark room, they're never there, even in the worst stories of white-collar crime. They're more of a slow process of things getting out of control.
So what were some of the initial creative ideas that, I guess, if done right, or could have turned into something great?
So this initial creative idea really was a good one. It was this idea of taking these securities, taking people's mortgages, making securities out of them, and therefore being able to get more capital to American homeowners. And when you go back to the 1980s and you listen to the testimony of the Wall Street executives who were pushing this idea in front of Congress, it was all about addressing what Congress feared was going to be this huge gap in the amount of capital to finance the boom of home ownership that was coming. So it did start out as it unquestionably started out as this almost idealistic thing. And I'd written a previous book about Enron, and that also in the collapse of Enron, which some of you in this room may remember. It was kind of a big scandal in the early part of this decade, and that too started out with a bunch of people. Every idea they had started out as a really good creative idea, and just it became corrupted along the way. And there was, I guess, in the notion of mortgage-backed securities, there was this fundamental problem at the root of it was that the bank that made the mortgage would then sell it off. So they didn't care anymore if you could pay your mortgage. And that sort of delinking of the borrower and the lender turned out to be the fundamental sort of evil at the heart of securitization.
So the story of the financial crisis can't obviously be told without subprime mortgages.
Right.
And I guess my question is, when they bundled all these mortgages, and the idea was, okay, well, we can put these subprime mortgages with these other better mortgages, and that way there's not that much risk there, and then we'll put some other subprime with other good mortgages?
Not really, no.
Nope.
It was
All
they
right.
stuck
I'll
all
read it again.
they stuck all the subprime stuff together often, but the idea was that you could take all these subprime mortgages that we're supposed to pay, and you could carve them up and direct the payments in different ways. So the people who own the supposedly safest securities got all the payments until they were paid off,
Okay.
and then the people who own the next riskiest securities, in basic terms, got the next set of payments. So because American homeowners were never supposed to default on their mortgages. If you owned the safest sets of these securities, even though they were made out of subprime mortgages, you were supposed to be able, these things were supposed to be as safe as U.S. government debt. They were stamped with AAA ratings by the credit rating agencies. And we can all debate how safe U.S. government debt is these days, but that it was supposed to be very safe at one point in time. And so they're actually, on some level, this idea makes sense. It's just when taken to an extreme, it no longer made sense.
Well, you talk about these kind of very smart people coming up with some very sophisticated risk models and showing that the chances of something going wrong were so tiny that it's
Right.
worth that these are very safe.
Right.
So I guess my question is, did that tiny thing happen? Were there that many defaults? Were the models wrong to begin with?
The models were wrong to begin with because the models all assumed that home prices only went up. And if you only go back to the Great Depression, actually on a nationwide basis, home prices only did go up. But if you had ever gotten in your car and sort of driven around neighborhoods and seen that this house that supposedly cost $500,000 was this little shack here, I mean, if you went out and did what the due diligence, the homework behind these mortgages that were being made, you would have said, oh my God. And we'd also never had a period where home prices had gone up as rapidly as they did in the 10 years before the collapse. So it was clear that if you were just relying on these models, that was probably a pretty silly thing to do. But Wall Streeters really like their models.
Sure.
I worked on Wall Street for a few years out of college, and someone once said to me, don't worry that you're not smart enough. Nobody here is a rocket scientist. And that was, it was in some ways probably true. This former physicist who worked on Wall Street said to me and my co-author that Wall Street is quantitatively illiterate, by which he meant that they really like these simple models because it appears like then you've got all the answers, you've got this model, you just plug things in, it spits out a number. But there's this great old adage about models that I love, which is called garbage in, garbage out. So, thank you.
The other thing that comes up time and again in the book, especially with like a firm like Merrill, is that the people who were in charge of really keeping an eye on the risk that firm was taking on were put into the basement. I mean, they were fired. I mean,
Yeah.
why do you think that happened?
One of the things I love about business stories is that they're always, in the end, stories about people, and it never fails to amaze me the extent to which the CEO of a firm can have an effect on the culture of that firm. And the story of what happened to Merrill Lynch, which really was one of America's great companies, is really a story of a guy, in part, of a guy named Stan O'Neill, who became the company's CEO. And he was, up from the bootstraps guy, the first African American to run a Fortune 500 firm, an amazing success story. But he had some flaws, and one of those was paranoia that people were trying to push him aside. And he slowly sidelined everybody at the company who he was worried might be a challenger to him. And over time, that resulted in everybody at Merrill who understood risk management being shoved aside without Stan O'Neill even really recognizing that this is what he was doing. And so Merrill Lynch had exposure to these subprime mortgages that went from $5 billion to $55 billion in the space of just a year. And it's basically that ended up almost bankrupting Merrill Lynch, and why the firm had to merge with Bank of America to survive in that fall of 2008 when all of Wall Street was falling apart. But it's really in many ways a tale of the top of Merrill Lynch. And business stories are always stories of culture and people, because things don't go wrong without that going wrong.
He's a great character. He golfs alone.
He does golf alone.
Like, that's how
he did golf alone.
What's he up to now?
I think hibernating and wishing he could get his reputation back. It's not a lot.
While other people want their money back,
right?
He wants his reputation back.
It's not a lot of solace to people who look at this and say, why haven't there been any prosecutions coming out of this? Why haven't these people paid? But the people at the top of these companies, like Stan O'Neill, like Angelo Mozillo, whose reputations have been totally destroyed, that's punishment to these people. It really is. It's not as if they've walked away scot-free, and it doesn't sound great to say that to somebody whose home is being foreclosed on, but I do.
If you said you can have your home, but your reputation's gone, most people would take that deal.
Right, and I understand that.
So tell me about, you were on Wall Street, and then you've written about the business world. Are these, for most of us, we don't know people who work on the street. Are these, by and large, if I met them at the bar, would I be like, hey, it's a good guy? Or are they Class A assholes?
It really depends on who you met. Wall Street is populated with a whole range of different characters, and from the outside you tend to look at the financial industry and think, well, it's just this one monolithic thing. But it really isn't. It's all these groups of people who sometimes are fighting with each other as much as they might be fighting with the outside world. And in sort of rough categories, I guess, investment bankers are probably the most objectionable. Depending on which firm they work at, they may be the guy who's sort of the least likable at the bar. But traders can be really, really fun, and there often isn't a correlation between whether somebody's a great guy to have a drink with at a bar and whether he's the guy who's going to totally screw up the world by
That's right. George Bush would be a good guy to have
selling
a
really
drink with.
bad products. So you have to be kind of careful of using that I could have a drink with this guy and really like it as a judge of whether the judge of the person's character, because it often doesn't work that way.
Would these be people that I would want to have a long, loving relationship with?
I guess it depends on what you love. I mean, if you really like somebody who made a lot of money, then that might be that. And there are
obviously
really,
I don't.
There are really.
No, what? I don't make it. What? No, what? That came out wrong. That came out wrong. Obviously she doesn't. How about that?
And there are some really good people who work on Wall Street, but by the same token, it is a money-driven culture, and it's a culture of comparison where if you make $1 million and the guy sitting next to you makes $1.1 million, then your $1 million feels paltry. And I think people who work in that industry, particularly in New York, maybe it's not as true in Chicago, but particularly in New York, tend to fall victim to that mentality over time, and they kind of lose sight of the rest of the world because it's such an all-enveloping world, particularly in New York.
In Chicago, I think we're just trading soybeans, right? I don't think it's. There is one Chicago angle in the book. It sounds like a transformer, a hedge fund called Magnetar or something like that. What was the story with there? And they were doing something with something Explain what a CDO is, because
oh Lord,
yeah,
can I spit this
you
out?
have
Can I spit this out in plain English?
Yeah.
Okay, so I guess the basic way to think about a CDO is that it's kind of a sick evolution of a mortgage-backed security. So Wall Street would take your mortgages and create these things called mortgage-backed securities out of them, which were basically securities backed by the payments on a mortgage. And then they came up with one more innovation, which was a structure called a collateralized debt obligation, or CDO. And what these things did is they bought all sorts of debt, including, over time, they began to buy a lot of mortgage-backed securities. So you had a couple of different iterations of complexity, where you had not just your mortgage being turned into a mortgage-backed security, but then you had this other thing out here that bought mortgage-backed securities. And this kind of innovation enabled this bubble to keep going long past when it should, because these CDOs kept buying risky mortgages long past the point where a real investor would have bought them. But the people who managed the CDOs were incentivized to manage as much money as they could, and so their interest was in the short term, and they cared less about getting out there and investigating what they were buying than they did about pumping up the assets they were managing and collecting fees. So it all became this kind of, I guess I'd describe it as sort of sick layering process, if you would. And then there were really clever hedge funds who figured out, so just like you can short a stock, you can bet that a stock is going to go down, you could also short mortgage-backed securities. And there were smart hedge funds that figured out that you could make a bet where you were short mortgage-backed securities or short the short part of a CDO. In other words, you were basically betting that people were going to lose their homes, and then you could own another part of that CDO as kind of a hedge where you were collecting the payments on it, and that this could be a really profitable trade. And it wasn't necessarily done with nefarious intent. Sometimes you could just make enough money by this trade that you didn't even have to really believe people were going to get kicked out of their homes for it to make sense.
But you win either way in this.
Yeah, but the way these things were structured, you could actually set up a trade where you made money either way.
How is that possible? That's what I don't get.
Because the market was so screwed up.
Yeah.
Because these products were so complex that most of the people who were buying them couldn't understand what they were buying, and so they were buying the credit rating instead. So if the rating agency said it was AAA, they were buying that without doing any of the work underneath it, because part of a mortgage-backed security might have been made up of hundreds of thousands of mortgages, and then a CDO might have been made up of 1,000 pieces of mortgage-backed securities. And so to get out there and investigate whether this thing was really going to do what it said it did, you'd have to look at thousands and thousands and thousands of homeowners and see if they were all going to pay their mortgages. And no one who was buying this stuff did that. They just said, "Oh, the rating agency said it's a AAA. I'm gonna buy that." And they bought it. So that created all this, the complexity of it created all these inefficiencies in the market that smart people could and did take advantage of.
We have to talk about the ratings agencies.
I hope that made sense, by the way.
Yeah, we're all there. We're all with her. We're all right. We're all there, right? All right. You can ask me afterwards if you want. The ratings agencies, like Moody's, and S&P, so they're rating all this junk as AAA, and the reason is that their whole business model at one point shifted, and now they were kind of in throes to the market rather than getting their money. Explain what happened to the rating agencies and why we can't trust them.
It's kind of a tragic story in a way, because the rating agencies were kind of the little grunts of Wall Street. They were the people who were responsible for looking at debt of a company, debt of a country, and saying, what are the chances that this money gets paid in full and on time? And that's what they did. And for a lot of years, they rated only sort of corporate debt or debt of a country. They didn't do this complex stuff called structured finance, which is what mortgage-backed securities are. But they started slowly but surely doing this, in part with some prodding from the government, which is the whole government angle is an interesting part of this story. And this became a huge, huge part of their business. And Moody's was a publicly traded company, so it had a bottom line. It wanted to make money. And over time, the culture of the rating agencies became corrupted, where the analysis was no longer first and foremost. And Instead, they wanted to keep these rich money flows coming in from rating this stuff AAA. And Wall Street firms played the rating agencies off of each other and worked with the rating agencies that would hand out the most AAAs. And so it became this game where the rating agencies handed out AAAs almost like candy. And because buyers couldn't really understand what they were buying or weren't willing to do the homework and bought things that were just rated AAA, if the rating agencies had ever said, wait, no, we're not going to slap our AAA on it, this doesn't make sense, the whole game would have come to an end much earlier than it did. So in a way, you can look at the rating agencies as some of the real villains of this story. Although, like every villain, it's a story with some complexity. Once again, it's not. They didn't set out to bring the world down. They just and then defend what they did to this very day and say, well, nobody could have seen it coming. But I think in the end, what they did is pretty indefensible. So.
Well, you do have a line in there where you say, I think you're talking about people who took on homeowners who took subprime loans and then the people who issued them, and you said it doesn't really matter who we blame.
Right.
But now that you're done with the book, who should we blame?
Well, actually, All the Devils Are Here is Shakespeare, so you mangled Shakespeare. You didn't mangle the title of my book.
From The Tempest, right?
It is from The Tempest.
Yeah, there you go.
But the part of the reason...
It's written right here.
Part of the reason... I wouldn't have known either if my publisher hadn't come up with it. So, but part of the reason for the title is this notion that it took a whole group of people for this to happen. In other words, it'd be really satisfying to be able to say, that's the person who did it. Look, let's put this person in jail and all of our problems are taken care of. But the story of the crisis is really the story of a lot of different actors over a long period of time, from Washington to Wall Street to Orange County, California, which was the epicenter of subprime lending. So it's hard to really label one villain, but I guess the person I point a big finger at is Alan Greenspan, the former chairman of the Federal Reserve, because the Fed's job, in addition to monetary policy, was also regulation of financial services firms. And starting in the mid-'90s, consumer advocates started coming to the Fed saying, there's a problem here. People are getting loans they can't pay back. Something's really gone wrong in the system. And you didn't have to be a believer in predatory lending, that people were getting taken advantage of. You could have just said, it's really bad for the banking system if people are getting loans they can't pay back. That's not great for our banking system. But Greenspan had this idea that markets regulated themselves, and that actors in the market knew what they were doing, and that intervening in markets was the wrong thing to do. And so he simply basically ignored the consumer advocates and the people who were saying this is getting out of hand. And I put a good deal of the blame for what happened on him and on people in Washington, because in the end, it wasn't Wall Street's job to protect the American public. You can look at what they did and say it was immoral and unethical, and how dare they. But
we expect that.
But that we should expect that from Wall Street. But it was Congress's job and the regulators' job to protect the American economy, and they failed to do that.
Well, Greenspan's home now, reading his Ayn Rand.
Yes.
So we don't have to.
Exactly. Justifying his actions.
Well, Bethany, thank you so much for coming by.
Thank you.
Bethany McLean, author of All the Devils Are Here.